Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Shawn Cruz. He's a manager of Trading Srrvices over at TD Ameritrade, and we're going to take a look into just how well earnings season is faring so far. Before we get into that, Shawn, let's just get a quick update on what you're looking at in the market for today.
Yeah, it looks like the markets are really trying to figure out how to digest what we're hearing so far in this earnings season. And so that's where we're getting somewhat, I'd say of a flat to muted reaction so far today. Things seemed a little bit more optimistic, actually. I think the Google reaction this morning, Google selling off, it's a really big component in the S&P 500, probably acting as a little bit of a drag to the index today. So it'll be interesting to see how we fare going into the start of next week, because after the end of this week, we've heard from 80% of the market cap of the S&P 500 will have reported, but we have the all-important retailers who usually bring up the tail end of earnings season. I think that's going to really set the tone for how investors and how analysts really digest what we take away from the earnings reports that we're going to get this month.
Especially since a lot of the positivity has been centered around the consumer. Let's take a look at our first chart, because you had brought this up in your earlier comments that we were near all-time highs yesterday. A little bit of a mixed bag today, but what are you taking a look here on this chart? A little bit more longer term, obviously, than just one day.
It is, and so we were able to kind of break above what looked like a pretty well-defined resistance level on the upside. I think what that's taken, one, is that earnings are coming in ahead of what the expectation was. I still don't think they're great. I mean, we're happy because earnings aren't as bad or aren't as negative as we thought they were going to be, but they're still expected to come out a little bit over 2% for negative growth year over year. But we are getting some optimism on the trade front. Supposedly phase one of what's supposed to be 3 phases is going to go off. It looks like they're going to get that signed and set into place. So then we're going to start focusing in on phase 2 or 3. And I think that's where the risk is. It was phase 1, a lot of the low-hanging fruit that we could get done here on the trade front. And now phase 2 or 3 are the sticking points. We always heard we're 90% of the way, but that last 10%, which is stuff they couldn't get past, is that what we're going to be looking at in phase 2 or 3? Is now we're getting to what has served as that barrier to getting a full deal done moving forward. And what is that going to do if all of a sudden we hear, you know what, we can't get through phase 2, this deal's falling apart, we get more threats of tariffs or capital controls, you'll start to see a lot of this optimism turn back around, and we could sell back below that previous resistance level that, we'll call it around 3,025 or 3,030.
All right, and what do you think about the Fed on Thursday? Tricks or treats on Halloween?
I think you're going to get that rate cut, but I think investors are going to be focused in on their tone moving forward for how they're going to manage guidance in 2020. Are they going to say, look, you've gotten your insurance cuts, we're going to stay pat until we actually do see a meaningful deterioration, probably from the consumers, what they'll be looking at to show that, to see that maybe the economy really is going to start taking a turn south. You need weakness out of the consumer. I think the Fed's going to say, look, business investment remains weak. The consumer's still strong. We've given the insurance cuts. We're going to be on hold and just monitor data as it comes out. The data they will be monitoring will be consumer sentiment, retail sales. The jobs reports are going to be very important. This Friday's jobs report is going to be very important for what we hear from wage growth, because I think that's going to be the first shoe to drop as you start to see softening wage growth, maybe some soft job numbers as well.
All right, let's go back to earnings for a moment. We can pull up our last chart here because, of course, we have Facebook and Apple tomorrow. Those will be closely watched. And then consumer next week. What are you looking for on this chart?
So one, if you look at what we're doing just so far in terms of revenue is actually coming in. We're seeing solid revenue growth, but the earnings growth so far still coming in slightly negative. I think there's the expectation that we're going to see further drops in earnings year over year, and that's what's going to push us from, we'll just say, -0.75% right now overall, down to a little below -2%. We'll just say 2.5% is where the estimates are landing right now for this earnings season. But if you really look where a lot of that weakness is coming from, it's coming from energies, it's coming from materials, and then also IT, which has actually been a pretty big driver of S&P performance this year. Information technology's had a pretty good year, starting to see some drops in growth there. So I would be monitoring which sectors are showing earnings growth, and maybe those are the sectors that you want to look at if you are going to try and find some opportunities to put money to work here. Find the sectors that are still figuring out ways to grow earnings year over year when we're supposed to see the overall S&P 500 have a little bit of an earnings recession, at least this quarter.
All right, Shawn, great insight as always. Thanks so much for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.